Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, the second quarter earnings season is almost history, drawing to a close here. As we speak, the retailers are reporting. That is the main focus. Our research director, Shiraz Mian, is going to fill us in on everything that's been going on since we talked last. How about these retail reports? How are they shaping up so far?
The picture has been mixed, Terry. As you know, we have a dedicated retail sector in our classification. And in the retail, we put the online vendors, the Amazon, the eBays, and these online travel agents, the restaurants, and then these big box hardline retailers. So Macy's and Walmart are on deck to report results Thursday. Costco has reported already, and the numbers were on the weakish side. The auto retailer, the Advanced Auto Parts, the O'Reilly Automotive, CarMax, their numbers on balance were negative. My sense is that a lot of what's happening and weighing on the market, this trade tariff, all that stuff, is a direct negative for retailers. So estimates for both Macy's and Walmart are kind of on the weak side, I would say. But I'm not expecting any fireworks from these guys.
Well, estimates for the retailers, especially the specialty retailers, for Q3 are getting cut. Is that a source of worry going forward?
I think it is. And if you look at the broader consumer space, it has been one of the strong points in the aggregate, in the big picture sense. So if we start seeing some moderation in households and consumers holding a little bit back, than what we have been seeing, I think that's something the policymakers have to worry about as they contemplate these different trade and all those moves.
And we're coming up to the critical holiday shopping period here soon, so there's that seasonality.
Yeah, absolutely.
Could this whole tariff situation be problematic for these high-end retailers, especially if the Chinese economy decides to really go south?
Absolutely. Like I said, the impact of trade and tariffs on the enterprise side, on the business side, is already, we saw plenty of evidence of that this earnings season, also before. Other measures of business confidence have been reflecting that as well. We have not been seeing that to the same extent in household and consumer spending. So if we see evidence of that, then that will be a next leg down in terms of the macro or aggregate growth picture. So that should be a worrying sign.
So give us the scorecard here. Give us the whole ball of wax for Q2, earnings, revenue growth, margins.
Absolutely. So I have the slide. Hopefully I can make it work. So 454 S&P 500 companies have reported as of this morning, Terry. For those companies, earnings are up 0.7%, revenues are up 5.1%, 75.6% are beating EPS estimates, and 57% are beating revenue estimates. The charts that I have here puts these results, the Q2 results, in a historical context. So we see the earnings and revenue growth. That's the left-hand side chart where we say the headline is Q2 growth rates compared. And then the beats percentages are compared on the right-hand side. So we could see in the left hand that growth is unsurprisingly very weak. We expected that, and we see evidence of that. Earnings are barely positive. Revenues have held up a lot better. We knew that. That was the case last quarter too. And in terms of the proportion of these companies beating estimates, EPS beats are about in line with historical trends. 75% we are showing here for Q2. The 12-quarter average is about 75% too. Revenue beats have been hard to come by, so 57% are beating revenues. For this group, the average has about 65%, so pretty notable miss on the revenue front in terms of being able to beat estimates. All in all, I would say no major surprises, either negative or positive. On the whole, as expected, I would say.
So this morning is the morning of August the 13th. What about these tariffs? Are they going to be a major impact for Q3 and Q4?
So this morning, we saw the headline about the administration pushing or delaying the onset of the next round of tariffs, which would have been a direct hit for the companies reporting next, the Walmarts, the Macy's, and the retail group as a whole. So we haven't really seen as much estimates cuts as I personally think need to happen if this is an extended downturn, if this is an extended issue on the trade front. In fact, for Q3, Q4, also for next year, my takeaway from looking at the data, Terry, is that analysts seem to be in a wait-and-see mode. They expect the issue to be resolved in the not-too-distant future and cut estimates only if managements explicitly guide lower. So there is no blanket cuts to estimates as a result of it, but as we discussed earlier, it's undoubtedly a negative for earnings.
Well, and estimates for the S&P 500, as well as the sectors that are affected by global growth, have been lowered for the second half of the year. Which sectors do you think, in particular, are going to be most affected?
So energy has been hard hit. Energy has always been, oil prices have been this economically sensitive commodity, and the downturn in energy prices has a direct effect on energy sector profitability. The cuts are broad-based across the board. Then finance is another one because of its exposure to interest rates, and as we know, interest rates have really come down lately. That's a direct negative for finance sector earnings.
Are those two going to be a bust?
Yes, so estimates are coming down. As we know, energy and finance have not exactly been putting the house on fire in recent quarters anyway. Though for Q2, finance numbers were better than most. But I think this recent downtrend, energy prices, interest rates, and the ongoing uncertainty about global growth, it's weighing on everyone, including those two groups.
They've been on fire, just not in a good way.
Not in a good way, that's right.
Do you have pictures for that to show us?
I do. I actually have. So here is the, you mentioned the second half of the year. I have here the Q3. You could see that estimates when the quarter got underway in mid-June was for a 1% decline, and now as of August 13, it's for a 4.1% decline. And here is the complete picture. So we are looking at numbers that have come out over the last 4 quarters, and then estimates for the next 3, which includes, I have highlighted the second half of the year. And as you could see, Q3 is negative, and Q4 is almost 2% growth. And that has come down quite notably over the last 2-3 months. So the earnings growth picture has not been very good.
But taking it all into account, everything we talked about up to now, add it all up, might we see a negative earnings picture for 2019?
That's how it looks like. So today, when we look at the way we calculate earnings, and our calculation is a little different, Terry, than what others like S&P, FactSet, and Thomson Reuters do because of the employee stock options. Our numbers show a modest decline. And I have a chart to show, as you could see here, the highlighted portion shows 2019. It's an earnings decline of 0.4%. If you look at this data and how everybody else looks at it, meaning stripping out employee stock options, then it's barely in positive territory. But the expectation, as we were discussing earlier, is for growth to resume next year. We have a 10.3% earnings growth expected for 2020 and almost 9% growth in 2021. You probably say 2021 is way too far away for us to discuss right now.
We have to get through this year first.
That's true. That's true.
So we'll just take it one step at a time. But I know you'll be keeping your eye on
Sure.
everything, so we'll impose upon your information, your informative
Absolutely.
nature, to keep us up to date on what's going on. And you can do that in Shiraz's written commentary on our website, Zacks.com. Just link to it right off the homepage with Shiraz. I'm Terry Ruffalo.